Hey, what's up everybody? This is Jessie with Minimalist Accounting, and I'm back with a new video for you guys on Goodwill, an intangible asset. As always, we're going to tackle this topic by introducing the definition, followed by all the accounting jargon you need to know, and then we're going to wrap it up with an example. Well, let's jump right into it. Let's say you're the owner of a popular pizza restaurant in your town with a current net value of $100,000. Business is good. One day, you're approached by Domino's, who makes you an irresistible offer to buy out your restaurant at $150,000. Now, would this be a good deal for you? A sweet profit of $50,000? Heck yeah! But how would Domino's record this additional $50,000 it paid to you on its financial statements? That right there is goodwill. In simple terms, how much is their restaurant's reputation worth? What about its strong clientele base? The excellent management? GAAP recognizes that all of these intangible things are an asset to a business, and when sold, their worth can all be grouped under the term goodwill. Accounting defines goodwill as the difference between the price paid for an acquired entity and the sum of the fair value of the identifiable net assets. Time for some accounting notes. Let's put that definition in terms of a formula. Goodwill equals the price paid minus the net fair value of the acquired business. Now note that the net fair value is total value of assets minus the total value of liabilities today. For more in-depth information on fair value, check out one of my previous videos linked below. For the journal entry, since we acquired this new business, their assets and liabilities are now ours, and we would show that increase on our books by debiting all the identifiable assets of the acquired business and crediting all the identifiable liabilities of the acquired business. Assuming we paid in cash, we would show this decrease as a credit to the cash account. And finally, the difference would be shown as a debit or an increase to our goodwill intangible asset. Furthermore, like all intangible assets, goodwill is tested for impairment. However, it is unique in that it is considered to have an indefinite life. It is tested for impairment at least annually, and whenever the book value exceeds the fair value, impairment exists. To record this journal entry, we would do so by debiting an impairment loss, and finally, crediting our goodwill account and reducing the asset. Now let's use all this information and go back to our pizza example and see how the accounting plays out. Let's assume your restaurant has assets totaling $200,000 and liabilities totaling $100,000 on the measurement date. Domino's comes into play and buys out your business for $150,000. Now, given all these facts, we can calculate the net fair value of our pizza restaurant by subtracting the assets from the liabilities. This gives us a net fair value of $100,000. We calculated that by subtracting 200 minus the 100 for liabilities. Now, let's calculate goodwill using the formula from the left. We know that goodwill equals the price paid, which is the $150,000, minus net fair value of $100,000, giving us $50,000 in goodwill. We can see that the same can be calculated using journal entries. Let's use the information on the left and look at what that journal entry looks like. We know that our assets are $200,000, our liabilities are $100,000. We, as Domino's, paid $150,000 in cash, so we reduced that account. And finally, we have a resulting net goodwill of $50,000. Finally, moving on to impairment, assuming that there was an impairment of $10,000 by the current year end, we would debit an impairment loss of $10,000 and credit a goodwill for the same, reducing our asset, reducing our goodwill by $10,000. Note that we could have arrived to the value of goodwill using either the formula or the journal entry method. That's it. You did it, guys. Keep up the great work. Let me know if you have any questions or video suggestions in the comments section below. Thanks for watching. See you in the next one.